Last at a Payments New Zealand conference, and for those of you, I see a lot of familiar faces, so 6 years on. For those of you who I do know and who remember me, I was involved in New Zealand for about 12 years working on various banking projects, including rewriting bits of KEX for Payments New Zealand. But for the last 4 years, I've been based up in Southeast Asia. So I spent 3 years in Malaysia working on various banking projects, and then for the last year have been in Indonesia. And during that time, literally in the last 4 years, I have seen, to use an overused cliche, a paradigm shift. There is a massive change happening up in Asia. Largely driven by some of the technology that's coming down from China. So what I'd like to spend the next 20 minutes or so doing is explaining what's happening, but perhaps more importantly, provide you with a perspective on why it's happening now. And then I'll finish off by just providing another perspective on open banking, because it's linked to this digitization of payments. But maybe the driver is a little different to certainly the drivers that are in New Zealand. And we'll finish off with that. So the first thing that's happening is the digitization of payments in Asia. And based on a Capgemini report that was published last year, you can see the difference in the growth rate to digital payments when you're comparing emerging markets in Asia with the rest of the world. And it's growing. The digitization of payments in Asia is growing at a rate that's 3 times the rest of the world. Now, part of that is because the emerging markets in Asia are coming from a very low base, and I'll show you that in a minute. So this growth is accelerating, it's very concentrated, but the other interesting thing about this change is that the method of the change and the tools that are available to these Asian markets to digitize payments is very different to the digitization of payments that we've seen in the developed markets, such as, and New Zealand is a classic example, but such as New Zealand, Australia, Europe and North America. So to illustrate the conditions that exist in those markets, so to use 2 examples, we've got New Zealand on the left-hand side. So this is I guess you could describe this as the current situation in New Zealand. And then I'm using Indonesia, which is where I'm based at the moment, as the converse example. And the headline, of course, is that New Zealand is often described as 90% digitised when we talk about consumer payments, and 10% cash. Indonesia is the reverse of that. So up until quite recently, Indonesia is 90% cash and 10% digital payments. And I'll explore that Indonesian demographic profile a little bit more at the moment. But if we look at some of the statistics of New Zealand and compare them to Indonesia, one of the measurements of how much cash is being used in the market, it's quite difficult to measure how much cash is being used in a market because by its very nature it's anonymous and hard to track. But one of the ways that we can measure it is to look at the amount of cash that's in circulation per head of GDP. So New Zealand has one of the lowest rates of cash in circulation, less than 2%. Compare that to Indonesia, it's around about 15%. And Indonesia is I think second to India, the second largest cash market in the world. Some of the other interesting statistics about New Zealand is that the digitisation of payments has happened largely off the back of cards and electronic funds transfer, to the point where New Zealand, I think, has the highest usage of cards per capita per annum in the world, number 1. And EFT is in the top 5. And those numbers, I think, were published by Payments New Zealand just last year, comparing New Zealand to other developed markets around the world. So Indonesia, very different environment. In fact, I've been in New Zealand for about the last 3 weeks. I think I withdrew $100 out of an ATM when I arrived here. I've still got that $100 in my wallet. You can survive here with a card, credit card, a debit card, and a mobile phone with a banking app on it, and you don't have to use cash unless you've got kids, I've discovered. Indonesia, yes, you can use a card if you stay in the top-end malls, if you stay in the 5-star hotels or you go where tourists go, but if you go and mix it out on the street with the locals, it's cash. And that's, or certainly up until recently, and I'll explain how this is changing. This is probably well understood by everybody in the room, better than I do, but the digitization of payments in New Zealand has occurred over the last 5 or 6 decades on the back of cards and electronic funds transfer, as I just mentioned, and particularly with cards. I mean, you can use a card everywhere. Maybe not use credit everywhere, but you can certainly use an EFTPOS card everywhere for the lowest value payment. And that is the result of a carefully managed program and development by the local banks over that period since the 80s to ensure that the domestic debit system is one of the cheapest card accepting systems in the world. So very different to the environments up in Asia. So very different story in Asia. And when I started working in Malaysia, I was working on a project that involved transforming the card acceptance system. And the central bank had a vision to remove cash and checks out of the system and to digitize payments. And what's happened in Asia is that particularly in markets like Malaysia, Indonesia, the Philippines, Vietnam, is that terminalisation has hit a ceiling. And yet, as I just showed, the acceptance of digital payments in Indonesia, based on the back of cards and electronic funds transfer, has only penetrated about 10%. So cards have hit a ceiling. In Malaysia, that ceiling seems to have been around about 30%. And it comes down to, when you look at the demographics in Asia, that yes, the wealthiest people in the market at the top of the food chain are using cards, but you don't have to come down very far before you hit people who are almost living day to day, micro merchants, food hawkers. They are earning enough money today to buy their groceries and their food tomorrow, and they're living day to day. Some of them, those that are a little bit wealthier, live week to week and month to month, but they cannot afford to place a terminal in their premises and accept a card. And so the banks don't have a business model for placing terminals in those sorts of environments, so have ignored those environments. They're earning enough money out of, in Indonesia, the top 10%, or in Malaysia, the top 30%. There's enough there for them to run very profitable card programs. So what is causing the digitization of payments? And I would say that there's 3 key drivers, or 3 key aspects that have all come together now to enable an environment where payments are being digitized. So the first is smartphone penetration. So although banking tools for digital payment have only penetrated so far, smartphones have penetrated much further. So just to give you an example, Indonesia, smartphone penetration is about 50 to 60%, but Indonesians are huge users of smartphones, social media, apps, so to the point where Jakarta is the #1 city in the world for the generation of tweets. Jakarta tweets more than any other city in the world per capita. So the Indonesians are using smartphones and they're using apps, and the other technologies that have been delivered along with smartphones, of course, that are being delivered in Asian markets is people are always connected, internet now is reasonably good, real-time payments and lifestyle apps. And I'll give you some examples of what I mean by all of that. But the convergence of these technologies in Asia is one of the enablers of digital payments. The second thing is the gap in the difference between what the banks are prepared to deliver at a certain price to earn a profit and the penetration of smartphones. So banks might be prepared to cover 10 to 20% of the market. Smartphones cover 50 to 60% of the market. In Malaysia, it's almost 100% of the market. So there is a gap, a huge gap between what the banks are prepared to cover in terms of the products that they offer today or the tools that they have today and the penetration of smartphones. And then the last big driver is the regulators. So the regulators in most of these Asian markets have an active policy, and I'll show you, give you some examples in a minute, have an active policy of making their economies more efficient, more competitive, and that includes removing cash and removing checks and digitizing payments. So they're looking for ways to enable the digitization of payments. So you have these three forces at work in most of the markets across Asia. So we have, in that environment, the emergence of some new players. I know that most of these players have been talked about at various times throughout the conference, but certainly in Southeast Asia, these names are probably the biggest names. Paytm, of course, is an Indian example, and is certainly a very good example of a non-bank digital player that is enabling digital payments. So Southeast Asia often looks to India and Paytm, and Indonesia has very similar demographics to India. The other ones, though, WeChat Pay and Alipay, talk a little bit more about them in a minute. And then two very big operators across many Southeast Asian markets. In fact, Gojek, which is an Indonesian player, has just announced that it is going live in Vietnam and Thailand. So you've got Gojek and you've got Grab. So Gojek and Grab both started out as ride-hailing application providers. Alipay, online shopping and online apps, and WeChat, of course, social media. And another player that's come into Asia and has just gone live in India, of course, is WhatsApp. So WhatsApp is used commonly in New Zealand. So if you don't know WeChat, just think WhatsApp, but in Chinese characters. And everything that you can do on WhatsApp, you can do on WeChat, and more on WeChat. So what are these new players' models? So they've evolved over the last 5 or 6 years. When I started working in Malaysia in 2014, there was no Grab, there was no Uber. So they started around about 2014, 2015, and of course provided a huge or a much improved consumer proposition for calling a taxi. And in the initial stages of Grab and Uber, there was no payment associated with it. You were just hailing a taxi. And in KL, it's much, much easier to hail a taxi through Grab or Uber than it is to try and flag down a taxi or to join a taxi rank. For any of you, if you have used taxis in KL, you've then got the minute you get into the taxi, you've then got a negotiation that starts with the taxi driver. And you often end up, particularly as a foreigner, you often end up paying far more than the locals pay. So all of that goes away the minute that we start using Grab and Uber. So in general, all of these players are delivering what I'll call a lifestyle app, where they're digitizing the relationship between the buyer and the seller and providing a much more convenient, efficient, and beneficial interaction between the buyer and the seller. And the other thing that they do is that you use these apps regularly. So when you're in KL, you're using Grab daily. It's how you get around. When you're in Jakarta, it's Gojek. So Gojek's same as Grab, same as Uber, but Gojek started, if you want to get around fast in Jakarta, you get on the back of a bike, not into a car. So Gojek started as hailing a motorbike. And then grew to hailing cars, and so has become the Indonesian version of Uber. So you use these applications every day, and I'll talk a little bit more about Gojek in a minute, because Gojek has added lots of other applications to its suite of functions. Once these players got this critical mass of users, and we're talking, in Malaysia, we're talking millions of users. In Indonesia, we're talking tens of millions of users, to the point now that Gojek has more customers than any bank in Indonesia. These customers are using this app daily. They're hooked onto the app, and then these players introduced payment. Initially closed-loop payment, in-app payment, in-app payment, so that you could pay for the service that you were using from that application provider. And then came person-to-person payments, so that if you had a Gojek GoPay wallet and I had one, then I could pay you. And now we're starting to see these players creep into the general retail space. And how are they doing that? They're adding a scan QR code function into their app. They're putting a QR code sticker onto the retailer's desk. And people are now starting to use this balance that they have loaded into their wallets in these apps to shop more generally. And the first real example where this was successfully demonstrated, of course, was China. So you can see on this graph the growth of WeChat Pay and Alipay. WeChat Pay, of course, provided by Tencent. From about 2013, these numbers go right through to 2018. If you look at the WeChat Pay application, it is now past 1 billion users. 80% of those users are using the app for payment, at least semi-regularly. So these, and we've seen in that same period, China, which 5 years ago was a relatively cash common society, has now, at a very rapid rate, digitized its payments. The other markets, certainly in Southeast Asia, are all looking at China for this model. And these two tech giants are, of course, coming down into all of the markets in Asia. They're here in New Zealand, of course, but you're acquiring WeChat and Alipay customers from China. But if you go to Malaysia and to Indonesia, these players are looking to issue in the markets. And the reason they can issue is because they can compete against cash, they can displace cash. They can't do that here in New Zealand because you're already 90% digitized. So their entry for these players into a market is where you have a high usage of cash. So I want to demonstrate how these two players and other players have moved into using two examples. So I want to focus on Malaysia, where I saw this happen over a period of about 3 years, and then what's happening in Indonesia at the moment. And they're two quite different examples. So Malaysia has been on a regulator-driven journey since 1991. So that was back when Dr. Mahathir was the Prime Minister. And interestingly enough, Dr. Mahathir as of April, is again the Prime Minister of Malaysia. But in 1991, the government set in place a program and a vision, which they called 2020, which was to transform Malaysia into a modern industrial country, or a modern industrial market. And they looked at all of the parameters that you would associate with a modern developed nation. This is across all sorts of industries. This wasn't just for payment. So all sorts of areas of society. And they then tasked each of the government departments with, we need you to bring Malaysia up to these parameters. So in payments, what that meant was that they wanted to remove cash to a certain percentage, remove checks to a certain percentage, increase terminalisation to a certain per capita level, increase the number of debit transactions to a certain level. And then in 2013, the Bank Negara Malaysia, the central bank, published something called the Payment Card Reform Framework, or the PCRF. So PCRF set out all of these parameters for Malaysia to become a modern, developed nation for payments. And essentially, in a nutshell, that was digitise, remove cash and checks as much as possible out of the system, and digitise payments. And so as an example, back in 2013, there were 250,000 POS terminals in Malaysia, and they wanted to drive that up to 800,000 by 2020. So Malaysia has a population of 30 million people, and so those parameters, actually Australia is about 30 million people, those parameters are very similar to the Australian market. I started there 2014. By 2015, only a year or so into that program, the banks were starting to say, the terminal population has hit a ceiling. We seem to be saturated. We can't find any more retailers who will accept a terminal at the prices, at the MDR or the merchant service fee that we need to offer it at. And so what the banks started to do was actually, if you walk into a retailer today in Malaysia, you will see that there are multiple terminals on the desk, each from different acquirers. Part of that was driven by PCRF, where acquirers, to make their central bank-driven targets, just went in and installed a terminal next to somebody else's terminal. That's the sort of environment that we were creating. What we weren't seeing was an increase in card transactions. So 2015, 2017, during that period, we saw the rise of GrabPay, WeChat and Alipay, as I mentioned just a while ago. And these guys came in, they weren't competing against the banks initially, they were targeting the non-terminalised areas. So we've seen QR codes start to be deployed in Malaysia by these players, and of course they're also doing person-to-person and in-app payments, those three areas. And those three players lobbied the central bank, and the message that the central bank eventually picked up on was, we're not going to achieve our targets if we rely on cards and terminals. So to remove cash out of the system, we need to let these guys play and compete against the banks, because the banks have stalled and are not moving. So late last year, the Bank Negara Malaysia published something called the ICTF, so another framework, again to meet this 2020 target. So that's called the Interoperable Credit Transfer Framework. And essentially what that enables is any entity, bank or non-bank, to move money from an account to an account, doesn't have to be a bank account, and that transaction can either be person-to-person or paying a retailer. And the other key thing about it is that last line there, that payments, this is a Bank Negara Malaysia requirement, payments under 5,000 ringgit, which is about probably about 2,000 New Zealand dollars, must be free. No merchant service fee, no fee to either party involved, end user involved in the transaction. So this is the way things have played out. In 2018, Bank Negara Malaysia has started issuing e-licenses to non-banks who qualify for the criteria under ICTF. And we've seen initially the banks trying to compete head-on with these guys. What we've seen now is an environment of collaboration, and we've seen the rise of three groups. So WeChat, which is at the moment not aligned with a bank, a consortium of Alipay, Touch and Go, which was the bank-issued e-money chip card used for tolls and on transport, buses and trains around most of the major cities in Malaysia, and then a consortium of GrabPay and Maybank. So Maybank and CIMB are the two biggest banks in the market, and those three are now competing with e-wallets, QR codes, and person-to-person payments. So cards, of course, still exist in the market, still being used, running in parallel with this environment. Let me just finish off with talking about Indonesia. So I just want to reinforce a few of the things that I said. So this is certainly the environment that I'm working with and looking at now. Again, that 10% penetration of digital payments, 10%, that's mainly cards, and about just over half of that is debit cards. The penetration of banked, so people who have a bank account in Indonesia, is 36%, or I think now that's a number that's a couple of years old. It's around about 40% now. Penetration of smartphones is 47%. And in that environment, we have a multitude of e-payment providers that have come into the market. So OVO, which is a retailer-owned e-wallet, T-Cash, which is a telecom, a mobile network operator-provided wallet, GrabPay I've already mentioned, and GoPay offered by Gojek already talked about. That screen that you can see there on the right, that's a screenshot of my mobile phone. I use Gojek daily, GoPay daily. Look at all the things I can do with it. I can order a car, I can order a taxi, Bluebird taxi, I can order takeaway food, I can send a parcel, I can order a bike, I can order goods from shops that have signed up to be delivered to my home, I can order a massage to come to my home. So, you know, the list goes on. And there is now, although you can't see it on that screenshot, they've added a QR code scanner to that app. My local coffee shop has just put up a GoPay QR code. I can now pay for my local my coffee with a GoPay wallet. So these people are slowly, and at the moment they're just competing against cash. So the banks are not really feeling the disruption yet because they're sitting in their top 10%, which is 26 million people in Indonesia, and the richest people in Indonesia. So they're happily staying profitable within that top 10%. These new players with their e-wallets, QR codes, person-to-person payments, they've been given e-wallet licenses by Bank Indonesia, and they're competing against cash. They're displacing cash. So one thing I just want to point out on this last slide, of the 26 e-money licenses that have been issued in Indonesia, 15 of them, more than half of them, are non-banks. There are 11 banks that have also issued what's called e-money. So think of e-money as, you know, in the old days for banks in Indonesia, it was chip cards. Now it's a server-based wallet that you access through a mobile phone application. There are 11 banks out of the 120-odd banks in Indonesia that have issued these e-wallets, and only 2 of them are doing QR codes at the moment compared to their competitors. So I want to finish off by, if you think about this environment and what's happening in Indonesia, if we think about the environment of the way the banks are behaving in the market, you can think of a transaction between a buyer and a seller as a two-step process. There's an interaction between the buyer and the seller, and then there's the payment. which is provided on the bank's terms through bank channels. And this is the threat to the Indonesian banks. The new players, the GoPays, the GrabPays, the Alipays, are actually doing something to improve the interaction between the buyer and the seller. They're digitizing that relationship. And then they're just embedding the payment in it. So when I catch a taxi, I don't have to pay at the end of it. Payment comes out of my GoPay wallet when I get out of the taxi. Now, at the moment, the banks are saying, well, the banks were saying, we don't compete with taxis and takeaway food, so we don't care about any of that. But as you can see from that GoPay wallet, they're moving up the food chain, and it's not going to be long before they're competing against cards. And so the threat to the banks, I'm already an example of it. I move about ₹1 million, about $100, into my GoPay account every few weeks, and I'm using it for these essential applications. To get around Jakarta, I use it for takeaway food and so forth. So I'm moving funds down into my GoPay account, and I'm using the GoPay application. And of course, the risk to the banks is if this trend continues, the banks will lose any of the transactions that are going through their current account, and this may be a threat to card transactions, credit and debit in the future. So what the banks in Indonesia, quite a few of the banks in Indonesia have recognised this. They're all talking about it. At the moment, their strategy is, well, we'll go head to head with these guys. We'll put out our own e-wallets and we will try and attract customers to our e-wallets. But increasingly, the banks are starting to talk about, well, I'm never going to compete against a GoPay. It's not my, as a bank, it's not my business to provide that digitized relationship between a buyer and a seller. That's probably not something I can do. But I do want to make sure that the transfer comes out of my account, and I want to collect the data that goes through as a result of that transaction. And so maybe I let GoPay plug into me through an API. And so the initial drivers of open banking in Indonesia are certainly different to here and very different to Europe. The regulators are not talking about regulating open banking and APIs yet in Indonesia. It may actually be a defensive move to keep control of the account and to keep control of the customers, or certainly to retain the customers and not let them go to these, what are becoming giant players that are bigger than any bank in Indonesia. So that's a very quick snapshot of what is happening in Asia in terms of the digitization of payments, why it's happening now, and who's driving it.